Well, good morning and welcome to the webinar on investing for retirement income in a COVID environment. My name is Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle are equity partners and work alongside Plato to distribute their Australian and global income investments to the financial advisory marketplace. And today, I'm delighted to introduce Plato's Managing Director, Dr. Don Hamson, and Plato's Senior Portfolio Manager, Dr. Peter Gardner, who will take you through their outlook for income in this COVID world we're now living in. In terms of background, Plato are an independent fund management group that specifically manages high-income equity solutions for low-tax investors, such as retirees. This is different and very different to most other managers who manage money for clients in tax brackets. And because Plato manages their investments specifically for low tax, it means that they can invest differently. Suddenly, portfolio turnover and capital gains tax is no impediment. And it means that Plato can be more active and rotate through quality dividends throughout the year to deliver higher income. And it's important to note that Plato does this without being permanently overweight banks or other high yield stocks or sectors such as REITs or infrastructure stocks. And just one final point, Plato is purely long only in its approach. We don't use options or derivatives to boost income, which can often come at the cost of capital. So what's the outcome? Well, Plato's Australian Shares Income Fund has delivered over 9% income since inception. And importantly, we've also outperformed the ASX 200 on a total return basis since inception. And this has been at a time when a lot of traditional big income stocks like the banks, Telstra and AMP have struggled over the last couple of years. So turning to today's webinar, the presentation will last around 20 to 25 minutes and all attendees have the opportunity to ask questions via the internet. This can be done by clicking the questions tab on your screen. Well, that's enough from me. So without further ado, I'll hand you over to the Plato team of Dr. Don Hamson and Dr. Peter Gardner for today's presentation. Thanks, guys.
Thank you, Mark, and welcome everyone. First, we hope that you and your team are all safe and your families at this current time. We live in the most uncertain times that most of us have ever experienced over our careers in markets or indeed our lifetimes. Equity market volatility has now exceeded levels seen in the GFC. The GFC was a financial crisis. This crisis is a health crisis that is causing an economic and financial crisis. Now, before I start to talk about that, I thought it would be good just to update you with what's happening at Plato in terms of our business and how things are operating in such uncertain times. In terms of Plato operations, it's business as usual, or in this current world, as in all staff are working from home. We have access to all the normal systems. We are monitoring and managing the portfolios in the same way we would if we were all in the office. Our office is actually still open. We haven't triggered our business continuity plan because our office is open. People can go there if they want, and all staff have access to all systems, as I said. We've been at home since March 16, following a full test of our systems at home on March 6, although it's quite irregular for people to work at home. Most importantly, all the team are well and focused on managing your portfolios. From a Plato business point of view, quite a lot of people are questioning business models at the moment, but we are a very well diversified business. We have a range of retail investors, excuse me, a listed investment company, which interestingly is still trading at a premium to NTA even in this volatile market. We also manage money for many charities and a number of superannuation funds. We haven't seen any significant outflows from these clients. We know there are some clients that are facing liquidity issues, but we've had no real significant outflows from any clients, and in fact seen some small inflows from some. Importantly, Plato has no debt and we remain profitable even at levels seen last month at the lows in March. Indeed, we could be significantly lower before and still be profitable. We have a highly experienced team. There are 11 people in the team, Peter and myself on the phone today, but there are 9 others working from home. They're very experienced. Every one of us worked through the GFC, and I suppose from my point of view, I also worked through the recession we had to have, which was technically the last recession that we saw in Australia. And we're very focused on managing the portfolio, but in this sort of environment, it is very important to stress test the portfolio, assess the liquidity, focus very much on issues such as bankruptcy risk, stocks that may actually not survive this economic recession, because we do believe that an economic recession is now unavoidable. Importantly, the Plato portfolios are well diversified and quite liquid, very liquid actually, and we have actually analysed the things such as the spreads on the portfolios, and at this point in time, we see no reason to change the spreads on those vehicles. But that is something that the responsible entity is looking at, and we are looking at continually to see whether we need to adjust those. But at this point in time, no need. So if we now move forward to the environment that we live in, our focus is on income, and income is becoming even harder to find. The initial response of the RBA and central banks around the world that had capacity was to lower interest rates. We saw 2 25 basis point cuts in Australia to the current level of 0.25%. We and market economists expect that interest rates will remain at this level for well over a year. We don't believe the RBA will cut rates lower than 0.25%, because then they start charging banks or potentially for overnight cash. So I think that that is probably the floor we'll see. The RBA has also announced that they will undertake quantitative easing, and they're also providing funding for banks. If we move on, I mean, the issue was, even prior to those 250 basis point cuts, we excuse me, we saw that interest rates were actually in negative real territory. That is that if you look at the nominal interest rate that is being paid on 10-year bonds, overnight cash, or term deposits, if you take inflation away from that nominal yield, you're actually going backwards. So with another 50 basis point cut, and with 10-year bond yields trading down below 1%, we now see negative real rates across the board. Potentially the only exception is some banks have provided some special term deposit rates recently, such as the NAB has provided a 10-month term deposit. Don't know why it's 10 months of 1.75%, and that's about the inflation rate. So there are some bargains out there. I think one of the reasons the banks have increased their term deposit rates suggests a problem with their funding. But nevertheless, it's very hard for people to get income from traditional sources. And thankfully, if we look at what equity markets can provide, the yield on the Australian equity market is substantially higher than what you can get out of cash and bonds. Now, this chart is actually updated we only updated annually to the end of last year, and clearly cash rates and bond yields have gone down since then. The equity market yield on a historic basis has actually gone up as the markets have gone down, but we would, and we'll talk about this later, we would warn people that there will be dividend cuts across the marketplace, so you don't necessarily want to focus on historical yield. But still, the gap between where we see interest rates and dividend yields is still significant. It's also worthwhile, I think, looking back at the last crisis we had in 08, 09, the GFC. You saw the market fall, dividend yields go up, and then come back down as there were some dividend cuts. But you also see, and this is what we've seen now, is the policy response from authorities is to lower interest rates significantly. So whilst you do see some cuts on dividends, you also see that central banks cut interest rates, and say there's another 50 basis points off cash rates since this chart was delivered. I think it's also, though, important to see in the next couple of slides show us what actually happened to the dollar level of dividends. And I think this is quite important. I know it's history, and many of you have probably seen these slides before, but we want to focus in on the two recessions well, the one recession we had that we had to have, but also the GFC. We might focus first on the GFC. Now, just so that everybody understands this chart looks at the income stream that would be generated if you invested $100,000 into the Australian equity market or into cash at the start, the end of 1979, or if you like, the start of 1980. And it's the income stream that is generated, but it assumes that you do not reinvest dividends, nor on the cash example, you do not reinvest the cash interest back into the investment. You just stay with that capital value. You don't touch the capital, but you consume the income. So it's drawn from the perspective of a retiree that consumes the income. Now, in the GFC, we actually saw that prior to the GFC, gross dividends in Australia rose to, on that $100,000 portfolio, would have risen to around just over $60,000. And then over 2 years, that blue line falls. The blue line is the gross dividends on an index portfolio, fell to around $45,000. So there was about I think 27% fall over 2 years. The biggest 1 year fall, which was in the GFC year itself, was about 24%, but across 2 years, about 27%. So that's sort of a good indication of the fact that dividends across the market, and remember this is just index weighted, can fall around that level. It's not as obvious, but if you went back to the recession we had to have, which is back in dividends peaked in 1989 of that same portfolio. And it's interesting, they actually fell for 3 consecutive years, although the first 2 years, which was probably the true recession, were the biggest declines. And they fell just over 30%, but over 3 years. So again, we're looking at numbers around 30% type falls in dividends in the 2 previous downturns that we've seen, even though the GFC wasn't a technical recession. But that, to me, gives you an idea that at the broad index level, you can see dividends being cut. But then, they are followed by periods of dividend increases. Even after the GFC, we saw some substantial dividend increases. So I think that gives people a bit of an indication. The other thing to note is that whilst the dividends fell in those cases, or particularly the GFC, by around 27% over 2 years, if you go to the next slide, shows you the capital value. And markets, are always focused on sentiment, and sentiment drives them initially. And you can actually see in quite a large fall in the capital value. So this is actually monitoring that capital value of that initial $100,000 investment. So it actually got to a peak of around 1.2 million at the end of December 07, and then dropped on this slide about 40% over the calendar year 2008. If you actually went peak to trough, so if you went sort of using months, the highest month closing for the S&P 300 index, and the lowest month, the fall was actually over 51%, and indeed on a daily basis was a little more than that. So capital value fell about 50%, in fact, or just over 50% peak to trough, where dividends fell about 27%. So we generally think that markets and capital values do tend to exaggerate swings, and we would probably expect that dividends will fall less than the market this time as well. But I think history is important to look at, and it shows you the potential magnitude, although clearly this crisis is a little different to previous ones, but history is an important thing to look at. So let's move forward and look at the virus itself. I don't want to dwell on this because there's thousands of data points out, but I just want to focus one thing is, initially, I think we saw this as a China problem, and there was massive growth rates in China, which is the dark blue line. You had actually cases increasing by up to 120% a day at one stage. But the interesting thing, and I think this chart shows you some good news, and looking from what happened in China, was China imposed clampdowns around January 23rd, and within about 3 or 4 weeks, certainly within 4 weeks, the Chinese growth rates of cases of coronavirus actually fell to virtually zero, and have been pretty much at zero growth since then, so since late February. The problem when markets, Western markets really, developed markets started to get worried about the coronavirus was actually in that last week in February when you started to see, there's a bit of noise, but you started to see the growth rates in cases outside of China to the rest of the world at around 20% per day growth. And again, there is some good news because this chart's up to the 30th of March. More recently, over the last week or so, that 20% growth rate is starting to decline to around 10%, and we're seeing that in countries like even Italy and Spain in terms of the decline in case rates. But I actually think the case rates, there is a lot of noise around these. Some countries test a lot, like Australia. Some countries don't test very much, like Italy and the UK. So it's very hard to compare that. So we actually think the next couple of slides are probably more important and show the trends. This looks at death rates, because we think that death rates are probably, we'll say tell no lies, but I think they're more reliable because you can just not be tested. You don't know you have it. It can be people that are asymptomatic, so they never even know they have it. But we think there's more clarity with death rates. So here we've done a logarithmic chart looking, starting at countries, a variety of countries, looking at starting to map the number of deaths once 10 deaths have been passed. And the good news about that is you can see that the red line, the Chinese line, has flattened significantly, and it flattened really quite well after about 30 days, certainly after 30 days after it received 10 deaths, and that was pretty much close to the lockdown. So within about a month of lockdown, it sort of started to flatten right out. Also, comfort from this chart is that South Korea has actually had a very flat curve as well, and they never went to a lockdown, but they did do a very significant testing and contact tracing regime. Australia looks pretty good. There's not much there. The line there that we currently look like we're sort of are flattening the curve, but the problem areas are probably within Europe. You can see Spain in grey and Italy are the leaders, and this is a couple of days ago. I mean, their death rates have considerably increased since then, and the UK is also popping up. So we think this is a better way of tracking it, but it does show you that Australia is doing pretty well, and that South Korea and China have flattened the curve. The next slide also starts to look at, and this is a different one, I think, which also I think helps reduce some of the media hype about this. So what we've done here is we've looked at the mortality rates. So this is the deaths per million of population. I would say we've changed it here because most of the deaths in China were in the Hubei province. So we've actually divided it by the number of people in the Hubei province. So what we have here is that it highlights that Italy and Spain are certainly in some trouble. Their approach, in fact, overnight they both went over 200 deaths per 1 million people. Australia is doing well. We haven't yet got to 1 death per 1 million people. There are 25 million people in Australia, and we're a little under 25. But it does highlight that the UK, Italy, Spain, and increasingly the US are on some fairly rough trends. But it does highlight that China has got its game act under control, that Australia looks pretty good. I haven't put South Korea on this chart because they never actually went into lockdown. But I think these numbers suggest that the chances of dying are pretty low when you look at it in a population per million. We don't want any deaths at all, but still is the case that the number of deaths worldwide is significantly lower than a normal flu season. So yes, these things are bad, but I think we need to put it into perspective. So the issue is it's causing, to me, both a health, a supply, and a demand shock. Clearly, when you close down industries, when people are unemployed, you have a significant reduction in demand, and you can't even, you can't fly anywhere. So there's government decree. I mentioned before that the level of VIX has actually just exceeded that during the GFC. So it has been quite volatile and very sharply. I mean, this basically took 1 month to hit that level. Although markets have responded very favorably to stimulus in the second half of March, although I don't think it's all over yet. We certainly believe the full economic impact is still to come, given what governments have done. But the bottom line is, what does it mean for retirement income and for your clients and Australian dividends? So let's have a little look at what that means for your clients and dividends. But first, I just want to look at, before we go into that, and I'll let Peter talk about that, but before we do that, there's been enormous and very rapid response from a financial stimulus and monetary stimulus, although monetary stimulus didn't have a lot to do, but we've seen cash rates fall in Australia by 50 basis points. We've seen the RBA now moving to quantitative easing. And the RBA has also, fairly unprecedented, said it will provide $90 billion of low interest bank lending. So they're going to lend to banks so the banks can lend to enterprises. The US Fed has cut its rates out of cycle to 0. The Bank of Canada and Bank of England have cut by 50 basis points. New Zealand have cut by 75 basis points. Most of those countries are pretty much now, like Australia, are pretty much at the bottom of their interest rate cycle. But there has been massive liquidity injections by central banks around the world. In terms of size of stimulus, depending whether you include loans, etc., but the Australian stimulus package, including those loans, is over $300 billion. We've already had 3 stimulus packages, and there's potential for another one. We have doubled the New Start, but more recently the government has underwritten wage subsidies by up to $1,500 per fortnight, providing airline assistance and a range of things. So that, put it in perspective, even if we're not even the 300 million, but the $200 million plus extra the loans, so we're taking the 90 billion of loans from the RBA out of that, that number is still more than twice what was spent during the GFC. So you can see there's a substantial amount of financial stimulus. And these have been, I'd say matched, but you look at the amount of money that has been pledged by other governments. The US is 3.2 trillion Australian dollars, although you've probably seen the headline number, 2 trillion US dollars. Germany, which is not known for its largesse in this area, has put in 1.3 trillion, although a lot of that are loans. The UK, over 600 billion, Japan over 400 billion, and yet they aren't actually all that affected. So massive stimulus. I think I'll now hand over to Peter to start talking about what we're seeing about the individual company level and where we see the risks.
Thanks, Don. So on this chart here, we've broken up the stocks of the largest 20 dividend payers in the Australian market into whether we think there's a low risk, a medium risk, and a high risk of dividend cuts going forward. Now, I should mention that all of this is based on kind of current information that we've got, and that's liable to change going forward. And so we'll obviously be changing our portfolios if that information does change. But at the moment, we see a fairly low risk for the cutting of dividends of both BHP, Rio, and Fortescue, Australia's big 3 iron ore miners. And that's primarily because the iron ore prices stayed high during this time, as China has continued to produce lots of steel, expecting a stimulus from the Chinese government to come forward in terms of infrastructure spending. And when the Chinese does infrastructure spending, they need steel, which requires iron ore, and that comes from Australia and Brazil primarily. There's also been a few supply issues around the world. India and South Africa have just reduced their supply. And so that's actually kind of kept prices high. And so the price in US dollars hasn't really fallen at all, and in Australian dollars has actually gone up during this time. And so we still expect those miners to be very profitable at this time. We've also got some of the defensive sectors, such as telecommunications in the form of Telstra, Woolworths and Coles. We've seen the kind of panic buying. Their sales are doing very well during this time, and some of the healthcare stocks. Now, this isn't all of the healthcare stocks. We've seen Cochlear and Some others be challenged because of the reduction of elective surgery during this time around the world. Yeah, CSL and some of the others are fairly low risk of dividend cuts during this time. Some of the medium risk of dividend cuts are in some of the kind of diversified financial sectors. So some of the insurance stocks, which whose investment earnings have gone down a bit during this time, they've got a medium chance of dividend cuts. ASX, similar. AGL Energy, as power demand will go down. Macquarie Bank, for similar reasons, as markets fall, we expect they've got a pretty good chance of cutting their dividends in their upcoming results. Wesfarmers, similarly, they've got a reasonable amount of consumer discretionary spending as opposed to just kind of consumer staples, which is much more defensive. And also the Commonwealth Bank. Now, the reason the Commonwealth Bank isn't a high chance of dividend cuts is because they've got quite a lot of capital at the moment, and they're selling some of their existing businesses, which is increasing their capital position. And so they were talking about doing an off-market buyback later this year in August or September. Now, we expect that probably won't go ahead in the current market, but it may mean that they've got a reduced chance of cutting their dividends. However, Westpac, NAB and ANZ, we think there's a very high chance that they will cut their dividends. And actually this morning, the Reserve Bank of New Zealand actually announced that banks, like New Zealand banks, wouldn't be able to pay dividends, which effectively means that the Australian banks that make their earnings in New Zealand won't be able to distribute that part of their earnings. So Westpac, NAB and Commonwealth Bank earn about 10% of their earnings in New Zealand, and ANZ earns about 20% of the dividends. So you kind of expect at the very least they'd be cutting by 10 to 20%, the Australian banks, but we think it'll be likely to be 30% or potentially even higher. The oil stocks are under significant pressure at the moment. Woodside Petroleum, that's got basically is not making any money at the current oil prices, and so we would be surprised if almost any of the Australian oil stocks pay a dividend in the upcoming results season. Transurban is under pressure as toll revenues go down, so they've just recently announced that they'll only be paying out their free cash flow in their upcoming dividend, as opposed to they usually pay out a bit more than that. Centre, as you know, shopping centres are under pressure in the current environment. And South32, which is a diversified miner but doesn't have exposure to iron ore. A lot of those, like aluminium, those prices have come down, and so their earnings are similarly under pressure. If we move to the next slide, we can actually see that, and these are the first times that we've actually seen this happen in the Australian market, where companies that have already gone ex-dividend are actually deferring the payment of their dividends, or in some cases cancelling those dividends or reducing those dividends. And so here's a list of various stocks in the Australian market and whether we held them in this Plato portfolio or not, that have deferred their dividends, cancelled their dividends, reduced their dividends, or in a couple of cases have gone into voluntary suspension. So we'll be surprised if they pay their dividends as well. So it's a pretty kind of unprecedented time at the moment. Yeah, you can look through those kind of names yourself. But I will actually mention at this time that generally the Plato policy on paying out distributions from our Plato Australian Shares Income Fund is to pay out all dividends that have gone ex-dividend during the period. But in the March dividend, we're actually March distribution, which we've just gone past the March year end, will actually only be paying out stocks that have paid or distributing dividends where stocks have actually paid their dividends. So we expect the March distribution will be smaller than historical, but that will be made up for in the June distribution. And the reason we're doing that is just to be conservative, that if we paid out a distribution or distributed a dividend that then a company then decided not to pay it, then that wouldn't be the best for the fund. So yeah, we think it's best to be conservative this time and only pay out the stocks that have actually distributed. If we move on to the following slide, you can see that at this kind of time, it's extremely important to look out for dividend traps. And as you probably all know, that's a very vital part of the Plato process. And so here we've just got an example of a historical dividend trap, being AMP. And you can see its price on the grey line, which at the start of 2018 was over $5 a share. But as the Royal Commission was happening and all the stuff that came out around that, its price started dropping during this time Now, if you looked at it based on a historical yield, which is just looking at the last 12 months of dividends that AMP paid divided by the current share price, its dividend was actually increasing during that time and got to, and at the start of 2019, a yield of around 14 or 15%. And so if you were a kind of naive investor that just looked at the historical dividend yield, you would have said, wow, AMP's got a yield of 15%. This is an amazing stock, until it's cut its dividend by about 70% in February 2019, then didn't pay a dividend in August 2019, and then again didn't pay a dividend this year at the start of February. So you thought you were getting a high yield stock, but it turned out the yield you actually received turned out to be zero now. And so we think that's an important part of our process, and it's only more important as we come into this upcoming period to really be analysing which stocks are likely to cut their dividends, which stocks that the market is expecting will cut their dividends. So, I mean, in the case of the major banks, the market is pricing in a significant cut of dividends already. And so it's important to be aware of that and to avoid those kind of traps, the ones that the market potentially isn't expecting but are likely to cut their dividends going forward. If we move on to the next slide, you can see this is the Plato kind of active positioning. So we actually were up versus the market in the month of March, but here's some of the positions that didn't work well for us. We're underweight ASX, IAG, and A2 Milk. These were some of kind of the more defensive companies in the market that we weren't kind of positioned into. At this time, ASX has got fairly defensive earnings in that it loses some revenue when the market goes down, but it's also the turnover on the market has been going up, so that's actually been helping us. A2 Milk's largely exposed to China, and they haven't really seen a drop off in volumes of people buying their milk inside and baby formula inside China, and so they've been doing quite well. And IAG, people kind of assume that people are always going to need insurance, so yeah, they've actually been doing pretty well. Some of our overweight positions that haven't done so well is Macquarie, NAB, Qantas, QBE, and Aristocrat. These had all been strong performers, and in the case of Qantas, it's amazing that it went ex-dividend in February, announced an off-market buyback at the same time, and just within a month it cancelled its off-market buyback, has deferred its dividend payment till September this year. And it's just raised extra equity from the debt market at the moment. So things have changed very quickly in some of these stocks. In some of them, we've been able to increase our position when the market fell very strongly and we thought the market movement was overdone. But generally, we're staying fairly defensive during the current market, expecting this will go on for longer than people potentially expect. If we move on to the next slide, we can see what has worked in our portfolio. We've been underweight centre, shopping centres, Transurban and Sydney Airport, which have obviously been very affected by the travel bans and social isolation that everyone's doing. Oil Search and Woodside, obviously affected by the oil price drop. And the stocks that have worked well in terms of our overweights have been Telstra, Woolworths and ResMed, which are all fairly defensive earnings during this time. And BHP, Rio and Fortescue, which I mentioned before, whose earnings are holding up surprisingly well, and well, not surprisingly well, but they're holding up well. And it's kind of somewhat surprising that resource stocks would be defensive in this environment. We've been noticing this for a while, that when the global economy gets into trouble, generally China stimulates infrastructure spending, and that actually holds up the price of iron ore. So iron ore is actually more defensive than one would normally think at the moment. And lastly, for me, on the following slide, I just thought I'd run over again that which Mark mentioned at the bottom, but because our Plato income strategy uses rotation to generate our yield rather than just sitting overweight high yield stocks all around, and this just gives you a chart of when stocks are going ex-dividend throughout the year, so we can actually rotate through stocks rather than holding stocks all year round in order to get their dividend. This actually enables us to move into the areas of the market we think are going to have a good relative stock return, as well as the ones that are going to get good yield. And we think that's very important in the current market. Don, if you wanted to take over from here.
Yes, so moving forward to our sort of outlook for income over the next 12 months, and this is essentially our outlook for income from the end of March although I would say that the one number there that isn't is the term deposit number, which was an RBA one, but it would appear the bank's term deposit rates haven't moved a great deal, and there are a couple of special there. But if we look at now, official overnight cash rates are 25 basis points. So if you've got anything that's linked to that, some online bank accounts, etc., paying that rate, it'll be 25 basis points. 10-year bonds at the end of March had dropped to about 77 basis points. Both those substantially below what the inflation rate is. Term deposits, well, say that it depends on what you can get. The next three are really our estimates, and these are forward-looking estimates, so they take into account what we expect is a reasonable likelihood of dividend cuts. Because if you just looked at the sort of historic dividend yields on these on MSCI World, so we look at the MSCI World Index ex-Australia, that index's yield has risen to nearly 3%, reflecting falling share market prices. But when we take out withholding taxes and we take out the probability of dividend cuts, which we think is around 30% at the moment, given current information, then that drops that to around 2% yield for that index. That's if you have an index fund. We run a global shares income fund that gets substantially more income than that, but the benchmark hasn't. That benchmark hasn't really moved, but remember the value of those shares are probably down a little. The REIT index has fallen quite a strong way. But in fact, the historic yield on that's risen to around 7%, but we expect that after you allow for likely reductions in distributions, particularly amongst probably some of the shopping centres, that are more like a 5% yield would be a reasonable forecast for the next 12 months. And similarly in Australian equities, whilst the gross yield has risen to around 7%, if you look on a historic basis, adjusting for the likelihood of dividend cuts, that would drop down, we expect, to 5%. Because these are our point-in-time estimates actually at the end of March. I mean, I'm not sure if people have seen it. Some of you may have seen that overnight the New Zealand government has actually banned banks from paying dividends, so that will have an impact on New Zealand banks and have a small impact on Australian banks that have those earnings. I mean, that's similar to what's happened in Europe, as I think Peter said. So these are our forecasts, so that those levels are still okay. I mean, but we are in very tough times, and we are at the moment assuming similar sorts of dividend cuts to what we've seen in the GFC. We just look at, it's substantially lower than what we've delivered since inception, but these are very interesting times, and we will obviously get more than the 5% because of our rotation strategy that Peter mentioned. But historically, we have been able to deliver over 9% income and around 7% cash, and the rest franking credits. We expect even in this environment that we will deliver substantially more than the index. So even if that index yield drops to around 5% in a gross basis, we expect to get substantially more than that. So that's based on current market values of the portfolio. So just summing up, really in terms of market outlook and outlook, look, we certainly believe that volatility is here. We think volatility will continue for a number of reasons. I mean, for a start, there's the volatility about whether we've got on top of this virus. When will it will happen? It's definitely the case that we will beat this virus, but question is when. We believe recessions around the world are unavoidable. There will be a significant fall, certainly in the June quarters around the world, but even the March quarter, given how quickly activity dropped off, we'll probably see I think we will definitely see a technical recession here in Australia. Government policies, though, will be very crucial to how long this downturn is and how quickly countries and stocks and industries rebound out of that downturn. I think one thing we can say pretty much for sure is that interest rates will remain even lower for longer. So, there's no real, I think, likelihood of any interest rate rises around the world for some time. Dividends will be cut, as we've talked about. We currently expect that to be around the 30% level. The impact is very stock specific or sector specific, as Peter has mentioned. Some industries are actually doing better out of this. but clearly some are in significant trouble, I suppose, in the short term. We believe, though, that given the fact that it is very stock and sector specific, that the case for active management has never really been stronger. And importantly, I think, as Peter went through the example with AMP, although we could have used a number of stocks in this environment, avoiding traps, I think, will be more important than ever over the next 12 to 18 months as we, go through this ever-changing environment. But you can be confident that we're very focused on delivering income for clients and providing as best total returns as we can in this environment. So thank you for your time. I think I'll hand back to Mark maybe, and we can probably go through some questions. I've answered a couple of the Q&As online already. But Mark, over to you.
Excellent. Look, thanks, Don. Thanks, Pete. Look, it's always great to get your views on income investing, especially in such a volatile time for Australian equities with dividends certainly under threat. Look, a couple of the key takeouts from today's webinar is that we certainly are in a lower for longer interest rate environment. And as we said, there's never been a greater need to have active fund management and a fund manager who can specifically deliver higher income. And the funds are specifically designed for low tax investors such as retirees. And it's important, Plato not only invest for income, but they also invest from a total return perspective. And they've been able to outperform the ASX 200 since inception. And they've been able to do that and deliver some great income along the way. Look, just a reminder that we do have the opportunity for all attendees to ask questions. This can be done by clicking that questions tab on your screen. We have had a lot of questions come in. So what I'm going to try and do is summarize a few of the more popular ones. And if we don't get to them, because we've got so many come in, we will certainly get back to you on email. Guys, you spoke a lot about the large banks in terms of risks to dividend cuts. There's a couple of questions here with respect to the smaller banks. What's your view there, and will they potentially cut income or all income?
Yeah, I can take this if you like, Mark. Yeah, absolutely. We expect smaller banks will be potentially hurt by this even more than the larger banks are. The margins of the smaller banks are generally thinner than the larger banks, and their access to funding is more challenging. Yeah, if it's putting pressure on the larger banks, it'll similarly put pressure on the smaller banks as well.
Okay, there's a couple of questions in here with respect to not dividends, but more on the capital raising side. And what's your view there? And would you guys participate in capital raisings?
Yes, we would participate in capital raisings. In fact, we already have. Cochlear raised some money. Well, actually, depending on funds we do it, but we looked at those. So yes, we would be looking at those. There's actually a few in the marketplace today, and there were quite a few yesterday. So we'll look on those on a case-by-case basis as to whether we see those as good investments. I think the experience of the GFC is that many companies are scrambling to raise funds. They sell those stocks at substantial discounts. I mean, one of the difficulties that you face is that in many of these deals are heavily oversubscribed, and they often come in stocks where we don't own those stocks because whilst we were trying to participate for Cochlear, given that we didn't own it, it wasn't one that we actually liked, it's not a high yield stock, then you will find that often you will not get any stock, or if you do get some stock, it will be heavily scaled back. So the problem is a lot of the stocks that will be doing offers will be those that that are in financial difficulty, and it's quite likely that we won't own those stocks. And the way that allocations run, often it's a case of whether you already own that stock.
Okay, great, Don. Look, we've had a number of questions come in on Telstra in terms of its ability to maintain dividend. Any views there?
Look, I think in the short term, it's probably okay. It is getting the NBN payments, and to some extent, I mean, stocks like Telstra and one that's doing an issue today, Next DC, a lot of telecommunication stocks and data center stocks and those sorts of things are actually benefiting from this crisis, as we see, like pretty much probably all of us on the phone today are working from home. So they're actually seeing increase in demand and looking at actually adding people. I know Telstra. So I think in the short term, their dividends are actually pretty stable. And I think the issue for us, and we've flagged this before, is that if you go out a few years as the NBN payments drop off, as basically everybody is transferred to the NBN, and so Telstra no longer gets those payments from the government or from the NBN, I suppose, then the hole in Telstra's dividends is in a few years' time. Now, it may be that it does so well out of this environment and it grows that business that might start replacing the copper wires, but we'll still have to wait and see on that.
Okay, guys. We've got a few questions on healthcare stocks. They've held up well. What's your view on the sector, even though they generally don't pay much in terms of income?
Yeah, I'll jump in there, Mark. So, I mean, there's definitely a spread of stocks within the healthcare sector, which makes this kind of question a bit challenging in that there's some stocks that we hold that are fairly defensive in their earnings and we don't expect them to get hit. So, I mean, an example is Ansell, which we've got a kind of smallish holding in the fund. It just announced it maintained its guidance a couple of days ago because it's seeing extra demand for rubber gloves, offsetting the reduced demand from its industrials business. So they've actually been able to maintain their guidance. So there's certain stocks that are quite defensive within the healthcare sector, and then there's other stocks like a kind of Cochlear that is getting affected with the reduction in elective surgeries. And so it's definitely one that overall it's been quite defensive in this environment for obvious reasons. But it's definitely on a stock specific basis how much each individual stock is going to be affected.
Okay, I think we've almost gone around the grounds with virtually all the sectors, and there's been a few questions in relation to resources, and in particular iron ore miners have held up well. Why is that? If the world's going into recession, might that mean China will manufacture less? A kind of bit of a summary on a couple of questions that have come in. Any views there? Yeah,
look, I'll take that, Mark. I mean, our view on iron ore has been pretty positive for the last couple of years. And I would say, though, that we very much focus on what spot prices are doing and what they're doing in Australian dollars. And so, as Peter, I think, has already mentioned, iron ore prices have held up very, very well in this environment. Our iron ore miners are still exporting, and I think the government has seen that they want special, it's an essential industry because it's such an important export earner for us. So the fly in, fly out guys are still happening. Our view has been for a while that China needs to stimulate its economy to grow, and you put the coronavirus on top of that, and the very poor first quarter that China has had, although it's actually bounced back strongly in March, which is good news, is that China will need to stimulate its economy, and one way it does that is to build infrastructure, which requires a large amount of iron ore and a large amount of steel. They do manufacture, and their manufacturing is likely to be hit by the sort of global slowdown, and not to mention trade wars and things with the US. But not a huge amount of Chinese, of the iron ore that Chinese makes into steel is actually exported. They're not a big exporter of heavy equipment and cars and things like that. So most of their steel is actually used in construction and infrastructure, and we expect that particularly the infrastructure will need to be boosted. Well, Peter also mentioned there'd been a bit of some supply issues in a couple of countries. Now, they might be temporary due to shutdowns, but that is at the moment being positive as well. So we are still positive on the iron ore market, but we are watching it very closely because these things can obviously change in this very uncertain environment.
Look, thanks, Don. Look, that is all we have time for today. I know we haven't got through to a number of questions. There's questions in there on cash holding. The funds are fully invested, so but we will reply to anyone who hasn't had their questions answered. The Plato Australian Shares Income Investments are available in an ASX listed format on the exchange with the ticker code PL8. And they're also available in a fund format, which is available on most wrap platforms or direct investment or via M funds. And just letting everyone know, these investments are favourably viewed by external houses with either recommended or highly recommended ratings from the likes of rating houses with Lonsec and Zenith. We will be making this webinar available on the Plato Investment website later today. We certainly like to thank everyone for their participation, their engagement. We certainly did have lots of questions. And as I mentioned, if we didn't get to your question, we will respond to you via email. In terms of our next engagement with you guys, we're hoping to keep you up to speed with our Pinnacle distribution team. We'll hopefully reach out to you and speak with you, or via one of our next webinars, as we aim to keep everyone up to date with this fast moving environment. We certainly want to wish everyone a healthy and safe next couple of weeks, and we look forward to speaking with you on our next webinar. Goodbye and have a nice day.